The DFI is interested, the feasibility study is done, the financial model holds, the project is structured, and then the DFI asks the question that stops more African infrastructure transactions than any other. Where is the equity? Equity is not a formality. It is the most difficult part of African project finance because it is the most risk-exposed layer of the capital structure. Episode 6. Every source, every structure, and every mistake to avoid when raising project equity in Africa.
Most developers I speak to assume they need to fund all the equity themselves.
That assumption kills projects. There are 6 distinct sources of project equity available to African infrastructure developers. Most projects that close successfully draw from at least 2. Understanding all 6 and knowing which combination fits your project is what this episode teaches.
Walk us through the 6 equity sources.
The 6 sources. First, sponsor equity, the developer's own capital placed in the SPV, first loss position, typically 20 to 30% of total project cost. Second, co-developer equity, a strategic partner who brings capital alongside expertise. This could be an EPC contractor, an operator, or a sector investor who takes a shareholding in exchange for their contribution. Third, private equity funds, Africa-focused PE funds that take minority or majority stakes in infrastructure SPVs, with ticket sizes typically from $10 to $150 million. Fourth, Diaspora Capital. The African diaspora sends over $100 billion annually in remittances. Less than 1% currently reaches structured infrastructure projects, but the instruments to channel it exist. Fifth, DFI Equity Windows. AFDB, IFC, BII, Proparco, and DEG all have direct equity instruments for private sector African projects. This is patient capital that also signals quality to other investors. Sixth, blended finance and grant equity from PIDG, Get Fit, the Green Climate Fund, and Climate Investment Windows. Often non-dilutive or minimally dilutive capital that significantly improves the return profile on the equity below it.
Start with sponsor equity. Why is it so critical? And how do developers fund it?
Sponsor equity is the foundation of the entire capital structure. No DFI or institutional equity investor will commit capital to a project where the sponsor has no financial skin in the game. The sponsor's equity is first loss, meaning it absorbs the first hit if the project underperforms. It proves conviction. DFIs typically require 20 to 30% equity as a minimum, and they will specify this in their credit policy. The sponsor's equity must be injected before or simultaneously with the first DFI drawdown. It cannot be promised later. How do developers fund sponsor equity if they do not have it on their own balance sheet? 4 options. Personal capital from founders and directors. Company retained earnings from the development entity. Sale of non-core assets to generate liquidity. And, in some structures, a director loan, though DFIs will scrutinize the terms to ensure it is genuine equity risk, not disguised debt. One critical point. Sponsor equity must be unencumbered. Capital that has been borrowed to inject as equity, and is therefore also a liability on the sponsor's balance sheet, will be identified during KYC due diligence and flagged as a concern.
Let us talk about co-developer equity. What types of partners typically provide it?
6 types of co-developer. EPC contractors, a construction company that takes a minority equity stake in exchange for the preferred supplier position on the construction contract. This is particularly common in renewable energy and water projects. O&M operators who take equity in exchange for the long-term operations and maintenance contract. Their equity aligns their commercial interests with the project's performance over its operating life. Sector investors, African private equity funds, or family offices with deep expertise in the sector who bring capital alongside advisory support. Technology companies or equipment OEMs who take equity in exchange for deploying their technology solution. common in digital infrastructure and renewable energy. Local partners, developers with country-specific assets, land rights, regulatory relationships, or community connections that a foreign investor cannot easily replicate. And DFIs themselves, particularly IFC and BII, who take minority equity positions in transactions they are also lending to, creating a combined debt and equity position that aligns their incentives fully with the project. The key to any co-developer structure is a properly negotiated shareholder agreement that defines shareholding percentages, board rights, exit mechanisms, promote structure, and anti-dilution protections from the start.
Tell us about private equity funds in Africa. Who are the key players and what do they look for?
7 funds you need to know for African infrastructure equity. Helios Investment Partners, Pan-African, $3.8 billion under management, strong in energy, logistics, and financial services. Actis, emerging markets specialist with $12 billion in AUM, particularly strong in renewable energy and infrastructure across sub-Saharan Africa. Development Partners International, known as DPI, Pan-African, $2.2 billion AUM, active in infrastructure, healthcare, and technology. AIIM, African Infrastructure Investment Managers, the Rand Merchant Bank affiliated fund, with $2 billion AUM focused on energy, transport, and water across the continent. Convergence Finance, a blended finance aggregator that co-invests alongside DFIs in climate and development-aligned transactions, bringing concessional and commercial capital together. IFC Asset Management Company mobilizes private capital alongside IFC on larger transactions, creating a vehicle for private investors to co-invest at the same terms as IFC. And AfricaInvest, a North and Sub-Saharan Africa generalist with $1 billion AUM covering SME and infrastructure equity from $5 million.
What do these funds actually require before they engage?
4 non-negotiables. An equity IRR above 20% in the base case. PE funds have LP return obligations that typically require 20 to 30% in emerging markets. A clearly defined exit mechanism, trade sale, IPO, DFI equity buyout, or refinancing, specified upfront with a realistic horizon of 5 to 8 years. A strong management team with a verifiable track record in this sector and country. PE funds bet on people as much as projects, and a DFI anchor already confirmed or in active discussion. African PE funds almost never lead equity raises in infrastructure without a DFI providing the debt anchor. The DFI's credit process validates the project independently, which is exactly the signal PE funds need before committing.
The diaspora opportunity, $100 billion annually, and less than 1% in structured projects. How does a developer access it?
First, understand who the diaspora investor is. They are not an institutional fund manager with a 50-page investment committee process. They are an African professional living in London, Houston, Dubai, or Toronto, earning well, sending money home, and actively looking for ways to invest in the continent at better returns than their current savings account provides. They have emotional connection, sectoral knowledge, and in many cases, local networks the developer can use. But they have 2 constraints. Ticket size. Most diaspora investors operate between $10,000 and $100,000. And confidence. They need to believe the project is real, the promoter is credible, and their capital is protected.
What structures work for diaspora equity?
5 instruments. SPV equity participation. Diaspora investors take a registered minority equity stake in the project SPV with a minimum ticket of $10,000 to $50,000. This requires a regulated securities offering in the jurisdictions where investors are located. A diaspora bond, a fixed-rate bond issued by the project SPV or a government entity with a 3 to 10-year tenor and a defined coupon. Ethiopia, Nigeria, and Rwanda have all issued government diaspora bonds, and the model is now being replicated at the project level. An infrastructure savings product, diaspora investors place funds in a ring-fenced project savings account earning a premium rate, with the principal linked to a specific construction milestone. Co-investment alongside a DFI. The DFI anchors the equity raise, and diaspora investors co-invest at the same price, using the DFI's credibility as a comfort signal. And a diaspora private equity club deal. High-net-worth diaspora investors pool capital in a club structure alongside an anchor PE fund, with a minimum ticket of $100,000 to $500,000.
DFI Equity. You mentioned AFDB, IFC, and BII all have direct equity windows. How do they work?
DFI equity is different from DFI debt in two important ways. First, the ticket is smaller. Most DFI equity windows start at $5 million, making them accessible to mid-sized African transactions. Second, it is patient capital. DFIs take a long-term view, with equity horizons of 7 to 12 years, which aligns naturally with infrastructure project cycles. AFDB's non-sovereign operations window can take direct equity in private sector SPVs alongside its debt instrument. IFC takes direct equity stakes in developing country private sector companies with a typical range of $5 to $100 million, and IFC's equity position requires IFC performance standards compliance, just like their debt. BII, British International Investment, takes both direct equity and fund equity, with a particular focus on climate-aligned transactions.
What about blended finance instruments, PIDG, Get Fit, and the climate windows?
Blended finance instruments are the most underutilized equity source in African infrastructure development. The Private Infrastructure Development Group, PIDG, operates multiple facilities: project development grants through EAIF for feasibility and structuring costs, and Infraco Africa, which takes direct equity positions in early-stage African infrastructure projects. Get Fit, currently most developed in Uganda, provides results-based subsidies paid on project outputs, which function as grant equity by improving the cash flows the equity below them is valued against. The Green Climate Fund channels concessional equity through accredited entities. AFDB and IFC are both accredited. So ask your DFI contact whether your project qualifies for GCF blended finance. The climate investment funds operate SREP and CTF windows specifically for renewable energy. Any of these instruments, applied to your project before the equity raise, improves the IRR available to the institutional equity below them.
How does a developer determine how much equity their project actually needs?
3 inputs drive equity sizing. First, the DFI's minimum equity requirement. This is set in the DFI's credit policy and is non-negotiable, typically 20 to 30% of total project cost. Second, the financial model's DSCR. The more equity you put in, the lower the debt service relative to cash flow, and the better the DSCR. If the DSCR is marginal at 25% equity, the DFI may push for 30. Third, the project sector. Water and transport projects carry higher equity requirements than renewable energy because the revenue risk profile is less predictable. The practical approach: model the project at 20%, 25%, and 30% equity, and find the level at which the DSCR is comfortably above 1.3 cross, and the equity IRR is above 15%. That is your target equity quantum. Then map that quantum across your 6 sources to determine the mix.
Walk us through the equity raise process, step by step.
6 steps, in the correct order. Step 1. Confirm DFI debt interest first. A DFI term sheet or letter of interest dramatically de-risks the equity ask. PE funds and co-investors see the DFI's independent credit assessment as validation of the project's bankability. Without it, you are asking equity investors to take a first bet on an unvalidated project, a much harder sell. Step 2. Prepare an equity-specific investor pack. This is different from your IM. It leads with the IRR analysis, the exit scenarios, the governance structure, and the co-investor base. The financial model must clearly show equity returns under base, optimistic, and downside scenarios. Step 3. Tier your equity investors. Tier 1 is the anchor, a DFI equity window, a major PE fund, or a strategic co-developer who brings both capital and credibility. Tier 2 is co-investors who follow the anchor, typically smaller PE funds, family offices, or co-developers. Tier 3 is fill-up equity, Diaspora Capital, minor co-investors, who participate once the anchor is secured. Step 4. Approach the anchor investor first and exclusively until you have a term sheet from them. Do not approach Tier 2. Step 5. Negotiate the shareholder agreement heads: shareholding percentage, board composition, preferred return, hurdle, promote, exit mechanism, drag along, and anti-dilution. Step 6. Execute the equity subscription agreement, inject capital into the SPV, and confirm equity in place to the DFI lenders.
What return profiles do equity investors actually expect in African infrastructure?
3 distinct tiers. PE funds: Helios, Actis, DPI. Target levered equity IRRs of 20 to 30%, reflecting the political risk, currency risk, and illiquidity premium of African infrastructure. DFI Equity Windows, AFDB, IFC, BII, are more patient and accept 12 to 18% equity IRR because their mandate allows them to price below commercial market returns in exchange for development impact. Diaspora investors typically accept 8 to 15%, above their savings account return but below institutional PE, in exchange for the emotional return of investing in their home country's development. Understanding these tiers allows you to structure the shareholder waterfall so that each tier of equity gets the return it requires without overpricing the asset to accommodate institutional PE, when Diaspora Capital, at a lower cost, would fill the same slot.
Explain the equity waterfall: preferred return, hurdle, and promote.
The waterfall defines the order in which project distributions flow to equity investors. First, return of capital. All equity investors receive their contributed capital back before any profit distribution. Second, preferred return. Investors receive a preferred annual return, typically 6 to 10%, cumulative, before the sponsor receives any upside. Third, the hurdle rate, a minimum IRR threshold, typically 12 to 20%, depending on the risk profile, that the investors must achieve before the sponsor's promote kicks in. Fourth, the promote or carried interest. Once investors have received their hurdle IRR, the sponsor receives a disproportionate share of the remaining distributions, typically 20% carry, as a reward for the development risk they bore and the value they created. The clawback provision protects investors. If early distributions to the sponsor exceed what they would have received on a total fund basis, the excess is returned.
What are the most common reasons equity raises fail in African infrastructure?
7 patterns. First, approaching equity investors before the DFI has expressed interest. This is the most common mistake. Institutional equity investors in Africa will not lead in the absence of DFI debt validation. Get the DFI anchor first. Second, no defined exit mechanism. An investor will not commit capital they cannot exit. Ever. The SHAA must specify the exit route: trade sale, IPO, DFI buyout, with a realistic horizon before any commitment is made. Third, IRR below threshold. If your base case equity IRR is below 15% for a PE fund, the conversation ends before it begins. PE funds have LP return obligations. They cannot accept below threshold returns regardless of the development story. Fourth, valuation misalignment. A sponsor who values their early-stage project equity at a price that implies a development premium the market does not recognize will repel every institutional investor. Price your equity on the discounted cash flow, not on your development effort. Fifth, no audited financials for the sponsor entity. Institutional investors require 2 to 3 years of audited accounts for the project sponsor before they can complete KYC. Sixth, governance not established. If you cannot show a proposed board structure, SJ heads, and a defined decision-making framework, investors cannot assess whether their rights are protected. Seventh, wrong fund tier. Sending a $5 million equity ask to a fund with a $50 million minimum wastes both parties' time and signals a lack of research that damages the sponsor's credibility.
When an equity investor engages seriously, what does their due diligence cover?
8 work streams. An equity investor DD is often more intensive than DFI debt DD because the equity investor is taking a longer horizon risk with no fixed repayment schedule. Financial DD. Independent review of the financial model, IRR sensitivity analysis, sponsor financial accounts, and cap table structure. Legal and title DD. Land ownership confirmation, SPV structure review, founder agreement terms, and any encumbrances on assets. Market DD. Independent market study, competitor landscape, offtake risk assessment, technical DD, technology review, site validation, independent engineer confirmation, and CapEx validation. Management DD. Detailed background checks on the founding team, reference calls from prior employers or project counterparties, and verification of the track record claimed in the sponsor profile. ESG and Impact DD, particularly rigorous at DFI Equity Windows and impact-oriented PE funds. IFCPS compliance, gender lens criteria, community impact evidence. Integrity and KYC, beneficial ownership structure, source of funds, PIP screening, and AML policy framework. And Exit DD, comparable transaction analysis confirming that the projected exit is realistic at the implied exit multiple.
What terms in the equity term sheet should a sponsor negotiate most carefully?
4 terms where the sponsor's negotiating position most directly affects their long-term economics. First, the valuation and equity percentage. Every percentage point of equity given to an investor is dilution from the sponsor's promote and exit returns. Negotiate the pre-money valuation carefully, based on a defensible DCF, not a wishful estimate. Second, the hurdle rate and promote structure. The hurdle rate determines when the sponsor starts participating in the upside. A higher hurdle means the sponsor waits longer. Negotiate the promote percentage in exchange. 20% carry above a 15% hurdle is a common starting point. Third, exit mechanism and drag-along provisions. The drag-along right allows a majority shareholder to force a minority into a sale. Ensure the drag threshold is high, typically over 75%, to prevent an investor from forcing a sale you do not want. Fourth, information rights and reporting obligations. These create ongoing management overhead. Negotiate the minimum frequency, quarterly rather than monthly, and scope of reporting that satisfies the investor without consuming your entire management bandwidth.
For a developer ready to raise project equity, what does AIB Corp Ltd provide?
4 services. First, equity structuring. We design the capital structure, determine the equity quantum, and tier the investor base across the 6 sources based on your project's sector, ticket size, country, and return profile. We model the waterfall, test the IRR at each equity percentage, and identify the optimal blend of sponsor, co-developer, DFI, and PE equity. Second, PE fund and DFI equity matching. We identify the specific funds and equity windows whose mandate, ticket size, and sector focus align with your project, and where we have existing relationships, we provide a warm introduction that bypasses the cold origination process. Third, Diaspora Capital structuring. For projects with diaspora-accessible characteristics, country connection, relatable sector, defined return product, we design the Diaspora Investment Instrument, whether SPV equity participation, a bond structure, or a co-investment product. We manage the regulatory compliance requirements for securities offerings across key diaspora jurisdictions. Fourth, term sheet and SAA advisory. We sit alongside the sponsor during investor term sheet negotiations on valuation, hurdle, promote, exit, and governance terms, ensuring the final shareholder agreement protects the sponsor's long-term economics while meeting institutional investor requirements.
What is the first step for a developer engaging AIB Corp Ltd on equity?
A confidential initial consultation. You share your project, sector, country, development stage, equity, quantum required, and current investor conversations. We assess which equity sources are accessible for your specific project, what return profile is realistic, and what the path looks like. That assessment is confidential and carries no obligation. Visit u.aibcorpltd.com or email projects@afroglobaltrade.com.
One final piece of advice for a developer about to go out and raise project equity.
Sequence correctly. Get the DFI debt anchor before you approach the equity investors. Get the anchor equity investor before you approach the co-investors. Structure the waterfall before you sign any term sheet. And never, ever approach a diaspora investor, a co-developer, or a PE fund for equity in a project that you have not yet feasibility tested and financially modeled. Your first equity ask is your only first impression with that investor. Make sure you can defend every number on the page. Because they will rerun your model, they will call your references, and they will know if you are not ready.
The 6 stages, the 7 AIIM components, the DFI engagement sequence, and now the 6 equity sources. It is all connected.
It is one framework, the bankability framework. Every episode on this channel adds another layer of it. Episode 1 taught you what bankability means. Episode 2 taught you how to write the business plan. Episode 3 identified the sectors where DFI capital is flowing. Episode 4 gave you the DFI engagement sequence. Episode 5 mapped the full development cycle. And this episode gives you the equity layer. Subscribe for Episode 7, where we go step by step through how to build a bankable financial model, including the exact DSCR, IRR, and sensitivity structure that DFI credit committees require.
6 equity sources, structured correctly, sequenced correctly. I now know how to stack every layer of the capital structure, debt and equity.
That is Episode 6. Subscribe, share this with a project developer who is stuck on the equity question, and tell us in the comments which equity source is most relevant to your project right now. We read every comment.
Subscribe now. Every week, AIB Corp Ltd gives you the frameworks, the capital market data, and the deal structures that African infrastructure developers need to raise capital and close transactions.
Subscribe. Share this with every developer you know who is asking the equity question. And visit u.aibcorpltd.com, where our team is ready to help you structure and raise equity for your African infrastructure project.
Build the project right. Stack the capital correctly. The close follows.